Okay, we're now recording it. I'll go back to sharing my screen. Okay. Hopefully everyone was able to watch the videos that I'd sent. The class itself, we'll go through these slides, but the class itself, we're going to focus on four particular types of derivatives. They each have advantages and disadvantages, but they're all used within a larger portfolio. Primarily, we would think of these being used, to hedge some position that you have to lessen your exposure to risk. But if you are getting rid of your risk, there must be someone on the other side that's taking that. As we go through this, you'll see that all of these, it's two parties have to agree for this to take place. So if one person is hedging a risk, there's probably someone speculating, trying to make money on the other side. So we'll go ahead and get started with this. And so, this course is derivatives, right? And if you took calculus, you probably are familiar with the derivative, the mathematical derivative. And actually, that's where a lot of this comes from, is taking a derivative with respect to different things. But the easiest way for you to maybe think of this, especially if you haven't done calculus, it's just saying that it derives its value from something else. So we're going to talk about stock options. The value of that option is a function of the value of the stock, right? If we have a futures contract to get frozen concentrated orange juice, the value of that futures is based upon the value of that underlying frozen concentrated orange juice, right? So something is going to have value, and then we're going to derive another product off of that value, right? And we normally use this, like I said, in transferring risk. So there's a lot of different types of risk that we can transfer with this. So when we talk about swaps, a lot of times swaps are used for credit default. You may have heard of credit default swaps before. And that's one way of handling the risk, that somebody won't pay you the money that they owe. We also have things like interest rate swaps, where I can go from a fixed rate loan to a variable rate loan, or from variable to fixed. When we get into those particular contracts, I'll get into a lot more detail around how that's used and constructed. But just think of this as just a way for us to bundle risk in a way that's different than just a stock or a bond, right? This is a way for us to offset the price of fuel for our trucking company, right? Like as a personal story, I used to work, before I got my PhD, I was at International Paper. I never actually watched The Office, but as I understand it, that was a paper company. So it's the same type of thing where we would manufacture paper. But my particular job was in the supply chain. So I was a logistics guy, a logistician, as they say. And so I was involved in fuel price derivatives. We actually use futures mostly. But we could offset the cost of diesel fuel so that it would not impact our delivery costs as sharply. So if those prices went up, we had this position that would also go up, and the increase in that position would offset our fuel cost. And so that was a way for us to transfer away that risk of fuel price fluctuations, right? So even though it was really just about moving logs from a tree farm somewhere to a mill, or moving paper from some mill or a box plant, depending on what we were making, to some end customer, we could offset that cost, that risk that we had of fuel prices fluctuating using these types of derivatives. So that's what we're going to do. And as I mentioned before, we're going to do four particular types of derivatives. Mostly, we'll talk about a few others, but But these are the ones we're going to focus on because these are the ones that are most widely used. It's the ones you're probably most likely to come in contact with. And so I just really want to make sure we understand those. And so futures, forward swaps, and options. Futures contracts are going to be something that's a set volume. And so if I'm trading oil futures, all oil contracts will be written the same way. And you may think, well, not all oil is the same. You know, there's the light sweet crude, there's West Texas Intermediate, there's Brent, you know, there's all these different types of oil, both the viscosity, the light or heavy, and then the amount of sulfur content, that's the sweet versus sour. But we actually have exchange rates between those different grades of oil relative to Brent is normally what we're doing internationally, or you'll see West Texas Intermediate used in the United States. You know, gold is gold. You know, frozen concentrated orange juice is frozen concentrated orange juice. Pork bellies are pork bellies. So those types of contracts, it's not custom built, right? And sometimes, and when we'll spend an entire lecture just going over futures, sometimes you can't get the exact future that you want. You grow a grain that's not exactly traded on the futures market, but it's similar to a different grain. You can try to use futures to offset that. But if you want something that's going to be more tailored for what you need in particular, that's where we'll start doing things like the forward contract. So this isn't going to be standardized. These are going to be contracts that we're going to negotiate at that time. And so you'll see this used a lot, you know, for something that's just going to be a little bit more unusual. When we were offsetting fuel prices, that was really easy as a market. But maybe you grow rye, you know, it's not nearly as large of a market as something like corn. And so you may want to come up with a specialized contract for that. And the forwards can help with that. I mentioned swaps before with like credit default swaps and interest rate swaps. It really is what the name sounds like. You're swapping. So we just agree, I'm going to swap this income stream for your offsetting income stream. And so that type of swap, we'll contract it out. And these swaps can be through an intermediary, or it can just be two individuals. So I can contract with you, but then we always have what we call counterparty risk, right? The possibility that I go bankrupt or you go bankrupt, right? And so I'm doing everything right on my side, but I still get hurt because this swap will fail. Now I can take you to court and everything, but that's not what we want to do, because the only people that win when we have to do lawsuits are going to be the attorneys, right? Because they're going to have all these billable hours. And at the end of the day, if you're going through bankruptcy, I mean, what am I going to get out of you, right? I'm going to be at the very back of a long list of creditors. So, so there's always that risk when we do these types of swaps directly. So we can go through an intermediary like an investment bank, you know, call up Goldman Sachs and ask them if they will do that. So they end up taking on that counterparty risk because they act as a buffer between us, right? So if that person fails, I'm still here, and the bank is going to make me whole by continuing those transactions. But they do that for a fee, right? So you have to make a decision. Is it worth having this third party? Again, it's offsetting some of the risk, but you're going to be paying for it. And everything we're doing in derivatives, it's going to be about offsetting risk and how much it costs to do that. And then finally, options. This may have been something you've seen if you've already taken investments, Finance 324. Options are an option, right? You have the right to do something, the option to do something at a particular time, but you don't have the obligation to do that, right? And so you pay an amount of money that's determined in the market for the right to buy or sell whatever the underlying security is, like a stock. So those are going to be the ones we're going to focus on in this course. Now the three things that we normally think about derivatives being used for: hedging, speculating, and to do arbitrage. If you're hedging a risk, somebody's going to be taking that other side. And so they're probably thinking that this is a way for them as part of their larger portfolio to make money. So it's possible that two people are hedging at the same time and they're just taking opposite sides. So the way to maybe think of that would be, if I'm a large scale farmer and I am going to contract with General Mills, I'm going to give them oats and they're going to turn it into breakfast food or whatever. Then we can each lock in the price, because I'm worried that the price will collapse and they're worried that the price will skyrocket. But we can both hedge our risk by agreeing to a contract right now that I'm going to deliver it, and this is going to be our set price, right? And so we could both be hedging, but oftentimes the markets don't work like that. There's not going to be someone that perfectly offsets their risk with your risk. And so you need speculators in the market, because that's who's taking the other side of a lot of these hedges. If you've studied arbitrage already, wonderful. If you haven't, arbitrage is just where there's some sort of mispricing in the market. And so an example could be, you have one price in London and you have a different price in New York. And then we can use derivatives as a way to capture that difference. And we'll actually work through an example of this. But when you're looking at arbitrage, especially within derivatives, we have to think of the timing of what's going on. And we also have to think about the currencies involved. Because I just gave an example of London and New York, and in London, it's almost surely going to be quoted in pounds. And then in the US, obviously, we quote in dollars. And so, you'd have to look at what the exchange rates are like to see if this is really an arbitrage opportunity and take advantage of it. And so whenever you look, that's normally what the three things people will say: hedging, speculating, and arbitrage. But a couple of other things to think about: changing the nature of your liability. And so an example of this would be if you have a fixed rate and you want that to be a floating rate. And maybe I have a floating rate and I would prefer that to be fixed, right? So we can enter into a contract, like a swap in this case, where you agree that you're going to, well, I think I said you had fixed and you wanted variable, I had variable and I wanted fixed. So you could give me the fixed, which is what I wanted anyway, and I'll give you variable. And so we'll work through an example, or actually we're going to work through a whole lot of those, actually, the swaps. But the way we do that, is really just to change that liability where it's going to be fixed or variable, depending on what we need. And as we're going through this, it's not just a preference thing. Oftentimes, what we're looking for is to connect our liabilities with our assets. And so if our asset is a fixed rate type of asset, we probably want a fixed rate liability to go with that, because otherwise we're exposing ourselves to this interest rate risk where we don't need to. And anytime you expose yourself to a risk like that, you're not getting paid for it, right? So you're better off finding a way to offset that risk. And the easiest way can often be just changing the natures of the liabilities so that they better connect with each other. And then finally, I have, to change the nature of the investment. And so this is like where the credit default swaps and things like that come in. I really like what I have, but I kind of wish it was structured a bit differently. Instead of me trying to unwind a position, because this isn't, really looking at stocks and bonds. These are looking at more complicated portfolios and things like that. And so a lot of times these are not markets that are very liquid. So it's going to be hard to find a buyer. And if I do, they're probably going to want a much better price because of the illiquidity or whatever. And so what I can do is use derivatives as a way for me to get whatever it is I'm trying to get. Maybe I want more of a cash flow than I could normally get, or something like that. So I can use this to change that type of investment. You see this with hedge funds and a lot, but you even see this with high net worth individuals. If you think about some of these tech billionaires, the moguls, so if Zuckerberg, wanted to unwind a whole bunch of Facebook stock, that would probably send a real negative signal to the market, right? Everybody would just presume he knows something really bad and everything. So what he could do though is enter into, these derivative markets where he still holds that portfolio, but then he can change his own exposure there without sending that same type of negative signal to the market. Okay, so I'm going to start with futures here. So the names hopefully will be straightforward, and you can see how they connect together. If it's a futures contract, this is a set amount, right? So this will be, a given volume of some underlying commodity normally. And we're going to have the contract that is good for a particular month. Like we'll say this is the July oil future, right? And so when you hear future, you just think, okay, this is going to be something in the future. Okay, when we're talking about today within derivatives, we're always going to, instead of calling it the market price, because that could be confusing because we have derivatives markets. If it's what's happening today, that's the spot price, right? So if I'm paying on the spot, that means I'm paying right now for delivery right now, right? When we get into derivatives, a lot of times that's not the case. We don't want delivery right now. In fact, normally we don't even want delivery. We're just using it to offset some risk. And so, yeah, so whenever you're thinking of a future, just remember this is going to be a set contract. It's a block, right? And everybody's blocks are going to be the same, okay? And so, yeah, so future is going to be future, and then that's relative to a spot. And then these are some examples of exchanges where futures are traded. And so if I'm able to go to an exchange and trade it, then that it must be something that's standard, right? Because I couldn't go to an exchange and just say, yes, I have orange juice here, if everybody didn't understand exactly what a contract of orange juice meant, right? So, and so I was just giving you examples of those. So when we talk about the futures price, right, it's the price that we're going to sell it at that future date, right? And so my example where I was talking about for fuel, we would just constantly roll these things over, right? We would buy, 6 months out, and then we would end up selling at about 2 months out, sometimes a month out. We wouldn't go all the way till close to the expiration of this future, the maturity of it, because what we wanted to do was just we weren't trying to take gallons of diesel or anything like that. We were just trying to make sure that we were capturing any increases in fuel prices so that we would, make money. Understand at the same time, if fuel prices fell, we saved money in all of our shipping, but we would lose money in our futures, right? Because if I want to make money on one side, I must be losing money on the other side. And so that's how these futures would work. The futures price is going to be set in the market though, right? So the price is going to be a function of what the spot price is right now. But there's a lot of things that will go into that as far as supply and demand. So just like we could say today, I think fuel prices are going to be higher in June because people are going to be driving in June, right? And normally as soon as summer hits, people start having travel, you see prices go up. But then last year, we had COVID, and that severely impacted everyone's ability to travel. It saw a significant sort of decoupling in the market. Saw some weird things where gasoline prices were moving one way and diesel was moving a different way, and that had to do with the nature of those markets. You know, the personal vehicle market versus trucking companies and railroads. So, but they're all going to have their own supply and demand on any particular month, and so those prices are going to vary over time. Okay. When I first got into doing trading, everything was still open outcry. I don't know if anyone here has ever seen the movie Trading Places. It had Eddie Murphy and Dan Aykroyd. It was an 80s movie. They were futures or commodities traders. And you saw what open outcry looked like, you know, and it's people yelling, you know, and they make hand signals to say like how many contracts and, you know, signaling, you know, if they wanted to buy or sell. And you'd see the people holding the pieces of paper and waving them in the air and that kind of thing. And that's really how it worked. But now it really doesn't. The floors are still there, but they're just this eerily quiet for the most part. A lot of times people are really there more for the photo ops than they are for the trades, because so much of the trading is really done behind the scenes by computer, right? So you'll hear the algorithmic trading used. That just means there's a computer that's deciding whether to buy or sell. And so because you have all these automatic scripts that run in the background, and when they see price movements, they buy or sell, it's much less of people interacting and a lot more of just the computers going through it. So these are some examples of some futures contracts. So, you know, buying 100 ounces of gold at some price, right? In this case, it's $1,100 per ounce. And then this would be in December, right? So I can contract today for gold to be delivered in December, right? You see this example buying, or I'm going to sell 62,500 pounds, and I'm locking in my exchange rate of $1.55 per pound, right? So this would be an example if maybe you have, you're a US firm, but you do a lot of sales in the UK. So you're going to end up with British pounds, but you don't want them. You know, your manufacturing is in the US, and American workers don't want to be paid in pounds. They want to be paid in dollars, right? So I need to convert my pounds back to dollars. But I don't want to risk price fluctuations moving against me or something like that. I don't know what's going to happen between now and March, although now it's pretty soon to March, but I don't know what could happen. So I could lock in the exchange rate now, so I don't have to worry about what's going to happen. And then finally, you see an example of barrels of oil, and you're again locking in a price, you know, for future delivery. The vast majority of these contracts, like I said, are never delivered. People close them out. Normally, you do it at least a month before the month of the contract, just because that last month of the contract, that's when you see a lot of fluctuation in the prices, a lot of volatility. And that's because the people that really want it and need it, they're the ones that are getting active in that market because it's right there close to coming due, and they're really trying to get their positions, things like farmers or miners or oil companies or whatever. So that's why we normally try to get out of it at least a month in advance, because you just don't want to get caught up in that volatility. Because it's not helping you, especially if you're trying to offset. So. Okay. This is just a little bit of terminology. So if I'm going to buy, then I'm long. If I'm going to sell, then I'm short. And we're going to talk about long and short. You're going to hear that a lot. So that's just something, you know, to keep in mind as we go forward. And some of these problems like this, I'm not gonna go through it right now because we're actually going to use these for like a little quiz I'm going to put up. So but I just kind of want to talk through how we would do this. In January, an investor is going to go into a long future contract. They're going to buy 100 ounces of gold. We've got this set price, and we're going to do this in April, right? So in January, I buy the contract for me to buy the actual gold in April. And then in April, it turns out gold is a lot more, right? And in this particular case, what would the profit or loss be? Well, you can see how much the difference is per ounce, but then you have to remember that contract is for 100 ounces, right? So we have a volume and a cost of 1,100, and then we'll have a market price of 1,175, right? And so we can calculate what our profit or our loss would be based on that. Okay. Okay. So the futures, like I said, these are exchange traded. These are going to be set sizes and things like that. Over the counter is going to be for things that are going to be very unique to you, right? So you want to build the exact contract that you want, not taking the set contract that already exists in the market. And so these are going to be oftentimes really large. And if it's really large, you don't want to put it on the exchange. And I know that sounds weird. Like, why wouldn't you want to go out in the exchange? Well, you can really deform the market, right? If I suddenly show up and say, yes, I want to buy, 40 million barrels of oil, the oil market may freak out about that. They don't realize, no, I mean, my airline is going through this transition period and I'm moving to these new aircraft, and they don't understand all of that. And so using over the counter markets is a way for me to find people to take those other sides, and we can cut them into pieces that make more sense based on all of the traders involved. Because if I'm going through all the trouble of doing over the counter, I'm going to make sure I tailor it for what the specific need is. So that's included as well. This graph I wanted to include just so that you can get a sense for how big these markets are. And so this dotted line, hopefully you guys can see that, but it's down here. It looks pretty low, right? I mean, this looks like it's kind of small, but if you look, I mean, this right here is $100 trillion, right? I mean, this is, I don't know. That's like the value of the United States is $100 trillion, right? And when I say of the United States, I mean like every asset of the United States, not just the government, but all privately held, corporate held assets. But that's about what the exchange markets are. I mean, this is how big they are. But then this solid line that you see that's much larger, this is that over the counter. And when you see here, like, 600, $700 trillion, that's almost like when you were a little kid and you would say it's a cajillion dollars. Like, this is just really, really big numbers. But this only makes sense if you keep in mind that most people are never going to ask for delivery, right? So these are just, I took one side and you took another side. We're never going to see this actually go to delivery. We're just trying to offset our respective risks with each other. If you do notice, there's a big correction that occurred right here in 2008. That was at the financial crisis of 2008. And then you see another one here in around 2011. This was around quantitative easing and some changes that we made around there. And this is just a really large market. We're still trying to understand how to get our hands around these types of markets. But and we're going to talk in just a couple of slides about the 2008 financial crisis and how that played out a little bit. But I wanted you to get a sense for how big this is. I mean, this is derivatives markets. Well, just the exchange markets make bond markets look tiny, and bond markets make the stock market look tiny. And then when you look at the over-the-counter stuff, it makes those exchange derivatives look tiny. So each one of these is is like a bigger giant, right? Looking down on the little guy, right? And so it's just that much larger. Um, I don't know if you guys have heard the story of Lehman before, but um, if you ever watch the movie The Big Short, that's about that. HBO, if you have like the HBO Go or HBO Max or whatever their thing is, they did a good, I think they call it a docudrama about it. It was called Too Big to Fail. But what happened was we had a lot of people getting invested in real estate, right? And that sounds like it's wonderful, right? Real estate is it's a good investment. You know, there's only so much land; they don't make it anymore, right? Except for the volcanoes in Hawaii, maybe. Um, but the idea was real estate just goes up, so we'll just go out and keep making loans, keep making loans. And then what happened was people started realizing, hey, there's a lot of exposure here. I better start getting something to protect myself, right? And the big thing that people were getting involved in were mortgage-backed securities, or we have what we call asset-backed securities. Mortgage-backed is a particular type of asset, the mortgage itself, and selling those. But because we knew that those loans could fail, we would turn around and buy credit default swaps on that, so that in the event that there was a default, I could still get paid. Right, that's how that credit default swap. If in the event that there was a default, I would swap that with you. You would take that loss, and then I would get paid. Right, so it looks like insurance. Right, I pay money to the insurance company, and they never give me any money. But in the event I'm in an auto accident, then they pay me. Right, so I suffered a loss, and then they pay. And that's how the credit default swaps were set up. Well, we had so much tied up in all of these, and people stopped doing due diligence. I mean, I know it sounds trite or whatever, but that's exactly what it was. People were just accepting that real estate goes up, it doesn't go down. And so they got into a really bad position. Lehman was particularly bad in this case, right? They were leveraged about 50 to 1. So for every $1 of their own they had invested, they had borrowed $50 to invest in this. So they were just making all this money up front, but then they were not able to maintain that, because once they started to default, they could not get the income necessary, right? Those of you that may be a little older and you remember this, you may have heard about like frozen credit markets and things like that. That's because no one knew who was good for what, because there were so many defaults going on. And Lehman themselves ended up filing for bankruptcy. And when they did, that just threw more things, just lurched, because suddenly we had this major player that was defaulting, and banks don't default. What are you talking about? So this was a pretty big deal, and it took a long time for us to work through that. I mean, it was years, and in fact, if you look around the world, Europe never recovered. They got hit with that, and before they could even try to get out from under it, they had the Euro crisis, because they had countries that were in this bad position, like Greece and Iceland. So as countries, and then Iceland was able to handle it very well. But then I think the population of Iceland's like 300,000 people, so it's probably easier to come to an agreement as a small country. But Greece has gone through, I think, 2 or 3 governments since then. And if you listen to the discussions in the Eurozone, they're still trying to come to terms with this, because there's so much bad debt that exists, and so that's been an issue going forward. Because of this, they've changed a lot in the way the over-the-counter markets work. And they're trying to make it much more like an exchange. But like I said, the issue is exchanges are built on, we're all selling the same thing. My oranges are just like your oranges, right? And if I'm going with over the counter, normally it's because I have something that doesn't really fit well. And so it's to to handle that. So what we've tried to do more is to make sure we understand all of these existing contracts. So we have a clearinghouse now, that covers a lot of this, just to look at what is the exposure. If you let's see, it was Solvency two and Basel two were the two big banking accords where they were looking at how do we properly account for it. Because the other thing is you got to be careful holding this stuff on your balance sheet, because if your other party starts to default, then we have to mark all of those holdings down to zero, right? If in accounting, you probably learn about mark to market, right? If I'm holding a marketable security, I've got to take that and show what the current value is. And if you're going to default, then the value is going to go to zero, which means my bank's assets drop. And if my assets drop, I can be in trouble with the Federal Reserve because I don't have enough reserves anymore because some of my assets are now worthless. Which means I have to start calling in loans, which means my borrowers then have to come up with their money. Do they have it? And that type of thing. So, so the idea is trying to make this something that we can better keep a handle on. But as you saw, the size of these markets are just so large. They're international. So it is a challenge, but that's where we are. So, okay. I don't know if you've really gotten into what is systemic risk versus idiosyncratic risk, but the way to think of it is systemic risk is risk that exists because of the structure of the system itself, right? So, so if you think about a bridge, right? I got a bridge that crosses over the river. The bridge could have like central pilings, that it sits on, or it could be a suspension bridge where there's the cableway overhead, and the cableway has cables that are holding up the bridge. So is it going to be compressive strength or is it going to be tensile strength, right? The tension of a cable holding it up. Each of those have their own advantages and disadvantages, right? The risk of a suspension bridge would be in high winds. It can develop a wave to it, and then that can propagate through and build up and actually tear itself down, right? And that won't happen with a compression bridge. But its ability to handle shear forces can be greater in the event of like earthquakes compared to the compression bridges, which are more likely to fail. So within a market, we have systemic risk within the market, right? So I can't use the market to get rid of the risk of the market, right? So the systemic risk is just because these derivatives exist, there's always the possibility that people will fail. And so because of that, I have to always worry, about that possibility. So, so that's a good bit about futures. The forwards, like I said, it's over the counter. It's not going to be exchange traded. I put that as popular in currencies and interest rates. I mean, that's normally where you're going to see a lot of these forward contracts. Firms are receiving a currency that they don't want, or they're getting a fixed rate when they want, some sort of variable or something like that, or so it's some sort of rate that's going to fluctuate over time, and I don't want to be involved in that fluctuation, right? And so I can set up a contract that allows me to lock in some sort of fixed exchange for us, and we'll just keep that going forward, and we can set this contract up to go years at a time. And so if you're an international firm, these could be very very useful. Okay. Okay. I put that the forward price is the, delivery price if it were negotiated today. So you have to think about what it would cost to deliver it today. And that's how we're going to adjust the price. So it's not being set in the market in the same way, right? Because it's going to be a function of what that spot price is now. So so they'll vary based on maturity, but that's has to do with like interest rates and things like that. So this is to show you some examples. So this was back about 5 years ago. And this is going from US dollars to British pounds, right? And so if you notice the bid and the offer, you may have seen this as like bid and ask if you did investments already. But yeah, so that difference between the bid and the offer, if you notice here, it's that's $1.57 for bid, $1.57.46, and then $1.57.50. So it's not even, I don't know, like it's a fraction of a penny, right? I mean, it's a pretty small difference, but given the volumes, that's where the market maker makes their money, is that little bit of difference between the bid and then the offer, right? And so that market maker, that's where they're getting their profit from. And then if you notice in the 1 month, 3 month, 6 month forward, those rates change. And what that does is actually indicates what people think is going to happen in the future with the exchange rate, right? So I think that it's going to get cheaper to buy pounds, right? Because this is the number of US dollars per pound. And so that number is decreasing. Now it doesn't even decrease by, it's like by 1/10 of a penny over 3 months, right? So we're not saying it's going to move a lot, but we are saying that the dollar is going to increase in the market. I'm not saying as an individual, because these are just the prices in the market, but the market says, hey, we think the US dollar is going to get slightly stronger against the pound, but not that much. Right. So that's what those types of prices would say to you. So this would be an example. And again, this is what we're going to put out there, for you guys to work through. But just so you understand the nomenclature here, in May, you're entering into this contract. It's going to be 100 million pounds in 6 months. I can lock in this rate, right? And it's a long contract because I'm going to be the one that buys this in the future, right? So I'm going to lock in that price in the future. And so, excuse me. And then in December, right, we're going to have our exchange. And then the question is, what are the possible outcomes? And I'm sorry, I'll have to correct that. It should be 100 million, not 1 million on the second one. So I'm sorry for that. I'll correct that. But we've locked that in, right? So it could be that the exchange rate is just, we were optimistic about dollars and it turns out pounds appreciate greatly, or it could be dollars appreciate greatly. But we've locked in our price, right? So we already know I'm going to pay this much, I'm going to receive that much, right? So that's what happens with those. The option, this is, like I said, if you took Finance 324, you probably have already seen options. The two that we're going to focus on are calls and puts. A call is the option to buy and a put is the option to sell. When I was getting my stockbroker license, it's the FINRA Series 7, the way they told us is it's like you call to buy it or you put it off onto somebody else, right? And so call means you buy, put means you sell, right? That's the way to think of that. When we set that contract up, there's just going to be a price for it. And because of that early price or that that price that we're going to exercise at, that's going to be called our strike price. So I can say, all right, in 2 months, I'm going to buy your company XYZ for $30 a share. I'll buy 100 shares at $30 a share. That $30 a share will be the strike price. Now, I'm going to pay some current market price, but that market price is going to be based on a couple of things. One is how much time we're talking about, right? So the more volatile the stock, the more likely it is to reach a particular price in the future, right? If it's a very flat stock and I'm looking at a price up here, the probability of it going up there is pretty low. So it's the probability that it's going to be there. And then what is the price right now? So it's kind of like mean, and then you think like standard deviation, although it's a little more complicated than that, but that's not a bad way of thinking about it, right? And so there's going to be a price for the option, right? Something I'm going to pay to get the option or to sell an option, even if I want to write one. But there's that's set in the market, and then the strike price is going to be this is the price, and these are traded on exchanges. So they're going to be for a contract 100 shares. We call them a round lot. So it's going to be 100 shares at this strike price, and the strike prices are going to be set in the market 35, 40, 45. So we have very particular prices that those will occur at. They'll occur on a particular month. And so that's what drives the option. The options also come within 2 flavors. We talk about American and European. I think I have a slide. Yeah. So, and this is going to probably sound a little nationalistic or chauvinistic or whatever. I don't know. But when we talk about American versus European, the way I always learned it is American options are just like European options. They just have more freedom, right? So a European option, if it is on, March 15th, then it is on March 15th. If it is an American option, then it's up to March 15th. But if I want to do it on February the 13th, I can, because I have that freedom in an American option, right? And so when you're looking at the contracts, American versus European options, that's all it is. If it's an American option, you can exercise it whenever you want. If it's a European option, it's on that day of maturity. And this is just to show you some examples of Google. This was on May 13th, about 5 years ago. You see the bid and the offer, or actually I probably should have put bid and ask in this particular case because we're looking at the stock. So the stock was trading $532 and somewhere between those 2 cents. And so we have strike prices. You see here, 475, 500, 525, 550, 575. And if you notice, as you go up, this price, drops off, right? And that's because if it's currently trading at 532 and I have the right to buy it at 475, that's what we call in the money, right? It's already worth more than that, right? So of course, this is going to have a lot of value, right? Because it's already got built in, whatever, that difference in price is already built in. Presuming it's going to stay that price in a month, right? Where if you start looking at the 550, 575, that's much higher than what this price is. And so you see right here, all you're buying is time, right? There's no intrinsic value. We call that being out of the money. And then if you notice, as you go further forward in time, these prices go up. That's because you're buying more and more time, right? Because there's more time for it to go up to whatever higher stock price we need it to go to. Because these are call options, so this is the right to buy it, right? Remember, I call you up to buy it, where a put would be I'm putting it off onto you, right? So this is an example of the put prices, and you notice the relationship is the opposite, right? Up here, these high numbers, these are the ones that are in the money. These low numbers are the ones that are out of the money, right? Because, I could sell it at 475, but I could sell it in the market at 530. So I'm definitely going to want to sell it in the market for the 530, not the 475. But again, there is some value there because Google could crash. They get caught doing something, unethical or something, and the shareholders start selling off all this Google stock, and it could plummet. So there is some time value there. And again, the further out in time you go, from June to September to December, you notice those prices go up. Again, you're buying more time. So that's what you're seeing there. And this is the payout structure of this type of option. So if you notice here, let's see, what is this one? A strike price of $550, and then it's $29 per option, right? And so if it's 29 times 1,000 or times 100, right, that's 2,900. And if you see here, it's this is negative 2,900. So I have to pay that up front, right? So I pay 2,900 up front. And so that's what these losses are. But then once I hit $550, right, the value goes up just like the stock price would go up, right? So for every dollar increase in the stock, I get a dollar increase in my profit, right? And so once it gets up to 579, assuming no transaction costs, I'm not paying a commission or whatever, but at 579, so the 550 plus the $29 I had to pay, I'm back to zero, right? And then anything over 579, I'm making money, right? So if I want to invest in the stock and minimize my losses, right? So instead of just buying the stock and then having, this line be a little bit higher, but go all the way down to a very negative number, what would that be? It would go down to 55,000, right? So, imagine 55,000 down here and it goes all the way up, and then I'd have this line. What I can do is say, okay, well, I'm going to push the line down $29 or $2,900 for 100 contracts, but it minimizes this downside risk, right? Because the worst case, I lose 2,900, not 55,000. Okay. This is a put. Put is the other way. So put is, I'm going to put it to you. I'm going to make you buy it from me, right? So if I have a put of 525, and then it's 2240 per option, right? So what's the worst that can happen? They go bankrupt, right? So I have the right to sell a company that's worthless. And so in that case, right, I'm gonna lose that full value, right? But then as the value increases, right, it goes up until when it's positive, when it's above that 525, I get to keep $2,240. So if I'm pretty sure Google's just going to go up, right, I could turn around and buy that so that I'm locking in this, it's small, I grant you, right? But I can lock that in on the upside, but then understand on the downside, I can lose money all the way up until the company actually goes bankrupt. And this type of graph, I'm going to use these a pretty good bit, especially when we start doing like hedging and things, so that you can see how these can stack together to get other payoff structures. And these are some of the exchanges that trade options. The Chicago board is the one that we normally talk about the most, but Euronext and Eurex are growing as well. So the difference between the futures contracts and the options is the option is an option. You have the right to do it, but you don't have to do it, right? With a futures contract, you have to close out that futures contract. You don't have to take delivery, but you have to pay to close it out. And so because you have that obligation, the person on the other side, we monitor this at the end of every day with a futures contract. We settle up. So you can get margin calls every day, if the price is moving against your position. Options aren't like that. Option, you bought it, If you don't want to exercise, you don't have to. Now, if you write the option, you have an obligation to fulfill. I mean, that's why you got paid up front with your option, but you don't. But if you bought the option, then you're not obligated, right? That's why we call it an option. Okay, just going to mention hedge funds, because a lot of people, they hear hedge funds and they're wondering, why do these folks make all this money, and that kind of thing. And really what it is because hedge funds can do a lot of stuff that no one else can do. Like legally, they're just allowed to do things that I would not be allowed to just take your grandmother and invest her in, right? So the idea with the hedge fund legislation is that under the Securities Exchange Act, excuse me, these are high net worth individuals, or these are like financial firms. And so we expect them to be able to do their own due diligence. So we don't require a lot on the part of the hedge fund with disclosure. There is disclosure rules, but the types of things that they have to disclose is more like, okay, here's the data, you figure out what you want to do with it, kind of thing. And so it's not going to be offered to the general public because most of them fail. The ones that do well, they're home runs, and a lot of them are they just fail, right? If you think about those things that go on to Shark Tank or whatever, right? That's you can think of them buying all these things, and they may buy 100 of them, and 99 of them are terrible, but that other one ends up on QVC, and they make all this money off of it, and it more than pays for all the ones that they lost, right? That type of thing. And so they can do these types of investments and not worry, about, are they going to hurt someone's grandmother, in it. So we already talked about hedging, speculation, and arbitrage. The key thing to do or to remember is if you have a strategy, you need to make sure you understand why you have the strategy. If you start trying to take advantage of something that pops up, you may be taking on a lot more risk than you realize because you're offsetting a different position that you have or something like that. And we've seen a lot of really smart people lose a lot of money in markets because they would switch. And again, here's just a couple of other examples, that we'll use on quizzes, but just to make sure you understand, a U.S. company is going to pay 10 million pounds for imports in 3 months. What could you do? And I could say, okay, well, let me agree right now that I'll get $10 million in 3 months, but it's going to be this much in US dollars. And then I don't have to worry about what the exchange rates are going to do, right? That type of thing. So we'll show that. This second one, the investor owns 1,000 shares worth $28 a share. So $28,000, right? A 2-month put with a strike price of $27.50 costs $1, right? So I can buy 10 contracts because the contract's going to be 100 shares, right? 100 options. And so 10 contracts, that would cost me $1 per option. And then what does that look like? It would be this one. So if I don't hedge, right? So it's currently 28 a share, which is like right here, right? If I don't hedge at all, for every dollar increase, I'm getting an extra $1,000, right? Because I have 1,000 shares, right? So every time a share goes up $1, I get $1,000, right? On the other hand, I can pay this difference. And if you notice, I have a little bit less money all through here, right? Because I'm making less, but because I have these puts, right, I can make someone else buy it from me for $27.50, right? So the worst price I get is this $27.50 price, right? So over here, this would be $27,500, right? That's, that's the worst that I'll end up with, right? And so the probability of being in this area here is equal to this down here, right? So what we're doing is we're just saying, okay, I'm going to take a little bit less on all these upsides, but I'm capping my downside losses, right? And so that'd be an example of using hedging to minimize the losses that you have in your stock portfolio. And this would be an example of speculation. And then arbitrage, again, looking at a difference in prices between pounds and dollars. And then this is what the exchange rate is, right? And so you'd want to buy wherever it's cheaper and sell wherever it's more expensive. And you can do that at the exact same time, right? You'll just contact brokers in both exchanges, and you'll buy in one and sell in the other. Given what this exchange rate is, you'd pick one or the other. So, and so I'll put these slides up as well with the video, and then we'll have these as sort of like a quiz problems that you can go through. So, as far as the formula itself, when we're talking about these. This F equals S times 1 plus R to the T. F is going to be what the futures price is, and then S is the spot price. So whenever you see S, that's spot price. Whenever you see X, the letter X, right, that's the exercise price or the strike price for an option, right? So you're going to see, we got to be really careful talking about a price, right? Because prices can mean a lot of things. So we just need to be very particular with our language. The R is the risk-free rate of return or the rate of interest. We will quote that in what's called the continuous, right? And so continuous compounded interest rate. The reason we do that is not anything that we're going to necessarily do here, but when you're doing like derivatives, like the doing the calculus of some of these problems, it's just a lot cleaner when you can write things as a natural log. And so we like to use that continuous growth rate. And then T is just the time in years until we get there. And so you can raise T or have T be like 0.25 if it's for a quarter, 0.5 if it's semi-annual, or it can be years into the future. Right here I have 1 plus R. We actually have to include some other things if you have to pay for storage, for instance. So like oil, we always have to pay to store oil. It's those contracts are large enough that we're either paying for tankers or we're going to pay for oil tanks, normally near a refinery. So we would include that there as well. Okay, so here's an example using oil. You see the spot price is 40, the futures price is 50. The interest rate is 2%, the storage cost is 1%, right? And so you would just add in that storage cost as well to be able to come up with what you think the futures price should be based on that. And then you can look at the difference in where you think the spot price of oil will be in $1 and the futures price in 1 year today. Right, let me say that again. So the spot price in 1 year versus the futures price of 1 year today. Right, so I don't know how many people gamble, but it's almost like that's what you're doing, is you're trying to say, okay, I have a good feeling that, based on this, it should only go up to, I don't know what that would be, $40.12 or something. And then the $50, is this going to be, should I go ahead and buy oil basically? And then I'm going to sell it in a year because that futures contract is, sell the $50 futures and I'll buy the $40 of oil and pay for storage, and then in a year after paying to store it for the year, I'll basically have locked in that $50, and is that an opportunity? and this is where the prices go the other way. What could you do there? Because you won't actually necessarily own the oil, right? So that would be the other side. So let me stop sharing and then ask you guys, do you have any questions about this so far? Hello?
I think my only question is just like regarding the class in general.
Okay.
Is like, will we meet like this every week, or is just like,
Yeah,
like set up as an online class?
Yeah, it's set up online. Based on some feedback, I had some students say, "Hey, I really kind of need someone to do a set class," So a couple of people said that this doesn't work, but they're okay with watching the video recording. And so I plan to do this. Most of the time, I'm going to send you just video links. But once a week, I'm going to come on and use this as a time to answer any of your questions that you have, as well as go over new material, for the week. But if you're like, we have some people that are working right now, and of course, the class went up as a web class because we still have the COVID restrictions and all those things, which change how we operate, right? So I'm trying to keep everything as flexible as possible while providing structure for those students that need it, because some students just do better when they have a class period to meet in.
Yeah, makes sense. Thanks.
Yeah. So you're not going to be penalized if you're not here.
Okay.
Yeah. So I know some people are like, they're scared, like, oh my goodness, well, what if I can't make it or whatever? I teach finance and I never have to go out of my way to fail people, right? This stuff's hard enough on it as it is. I don't need to try to make anything hard. I actually try to be really flexible. So, yeah, just, and if you need something outside of that, like if you're just like, hey, can we, talk or whatever, I need you to help explain something to me. We can set up a time to talk outside of that, this 11 o'clock on a Tuesday, the time that works with your schedule and everything to go over any questions that you have. All right. Well, if there's nothing else, just sort of be on the lookout. I'm going to put a little quiz up that's going to have some of these problems that you can work through and everything. The way we're going to do this class is I'm just going to do lots of little things, like little bites, throughout the entire course. That way it doesn't feel like it's going to be overwhelming. There is a textbook that I'm using, but I'm not going to make you guys buy it because it's the textbook that I used when I was in grad school. And there's just a whole lot of math that if you're not, pricing these things, at an investment bank or something like that, a lot of times we just do the math to show off and show that we can do math. So in this one, we're just going to focus on, okay, let's just take the prices as given. How do we actually build this into our portfolio? Like that payout structure that you saw with the graphs, that sort of thing. That's what we're going to focus on is that kind of thing. How do I use this product to offset risk or something like that? So don't want this to feel like it's overwhelming or anything like that. We're just going to keep dribbling out small bites, and don't forget that I'm here for you. So just email me if you have any questions. I don't know exactly how long it's going to take for me to put this video up. It's a little over an hour. So it's just however long it takes Zoom to render it. And then I've got to upload it somewhere, and then I can give you guys the link. So once we have all that, then you'll be getting a link so that you can go back and watch this again. And yeah, I'm just here to answer questions that you may have as you go through it. So don't hesitate to ask me. So If there's nothing else, then you guys are good to go. Just be on the lookout for an announcement where I'll have, the link, and I'll also have like the little quiz for you to work through and everything on there. So, all right. It was great being able to talk through some of this for you guys, and I'll be around. I'll see you next week if nobody talks to me sooner.